Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of confusing business talk. You guys are in for a treat today. We have a super interesting filing from Citius Oncology Incorporated. It is a quarterly report form 10Q. Now that sounds like dry stuff, but trust us, by the end of this you will know exactly what is going on inside this company. Before we dive in, if you love getting these straight up insights from company filings without all the corporate jargon, make sure you hit that subscribe button. And hey, we have a fantastic Discord community where we break down these reports together. Link is in the description below, please join us. So Citius Oncology Incorporated is a pretty specialized company. They focus on cancer fighting drugs. Their main product is called Lympha, and it is for a type of cancer called cutaneous T-cell lymphoma. They just launched this product in December of 2025, so this report is super important because it shows us how that launch went. Think of this as their very first report card after opening for business. Let us jump straight into the numbers because that is where the real story is. This first big table here, the condensed consolidated balance sheets, gives us a snapshot of the company's financial health on two different dates. We are looking at the 31st of December 2025 and the 30th of September 2025. Total assets for the company went from about $100 million to just under $110 million. That is a nice increase, mostly driven by their cash and inventory. They have $7.3 million in cash right now, which is up from $3.9 million. That sounds good, but we will see if that is enough to cover their needs later. Now, liabilities, these are the debts and obligations of the company. This number actually went down from about $56 million to $51.5 million. That sounds like good news, right? Reducing debt is usually a win. But let's look closer. They owe $18.25 million for licenses, and that number went down to about $22.65 million. This is interesting because it means they are paying down some of their big license obligations. However, notice how their current liabilities, specifically the license payable and accounts payable, are still quite large. This tells us that a significant chunk of their debt is due soon. Stockholders' equity went from about $44.8 million to $58.4 million. This is a pretty decent jump. It looks like they raised a lot of money through selling stock, which is why their additional paid-in capital went up significantly. This is an important point for a company that has just launched a product and likely needs cash to grow. Now, for the part that really tells us about their performance over a period, this is the statement of operations. It shows us how much money they made and lost. Here is the big news. For the 3 months ending the 31st of December 2025, they reported revenue of $3.9 million. This is huge because in the same period the year before they had zero revenue. This directly correlates to the launch of Lympha in December 2025. They are finally bringing in money from their product. But bringing in revenue comes with costs. Their cost of revenues was about $789,000. This is the direct cost of producing and selling Lympha. This resulted in a gross profit of $3.15 million. So they are making money on each sale. This is a very positive sign for a newly launched product. However, their operating expenses are quite high. Total operating expenses were $8.4 million. This is a significant amount, especially when compared to their revenue. Research and development expenses were about $1 million. This is what they spent on developing new products or improving existing ones. General and administrative expenses were $2.8 million. This covers things like salaries for management and administrative staff. And then there is stock-based compensation, $3.9 million. This is a really big number. It represents the cost of stock options and awards given to employees. This indicates a heavy reliance on stock compensation for their team. Because their expenses are so high, they had an operating loss of $5.2 million. Even though they are making money on sales, they are still spending more than they are bringing in overall. This is typical for a company in its launch phase, but it is something to keep an eye on. And the net loss for the quarter was $5.5 million. This is a big number, but it is less than the $6.6 million loss they had in the same period last year. So while they are still losing money, they are losing less money, which is progress. Also notice this number here, weighted average common shares outstanding. It jumped from 71.5 million to 87.4 million. This indicates that they issued a lot more stock, which is often done to raise money. We will see more about this in the equity section. This next statement shows us how the stockholders' equity changed. At the end of December 2025, their total stockholders' equity was $58.4 million. That is up from $44.8 million at the end of September 2025. This big jump is largely due to selling more stock. They raised about $15 million from selling common stock and pre-funded warrants. This is how they are funding their operations and covering those high operating expenses. And again, we see that large stock-based compensation expense here, adding another nearly $4 million. The net loss for the period reduces their equity by $5.5 million. Looking back at the end of September 2024, their equity was $46.1 million. So the company has grown its equity position, especially in late 2025. Now let's talk about cash. The statement of cash flows tells us where the company's cash came from and where it went. As expected, their net loss was about $5.5 million, but they add back non-cash items like stock-based compensation, which was almost $4 million, and that amortization of in-process research and development, which was $573,000. Then we see changes in their assets and liabilities. A big one here is accounts receivable increasing by $4 million. This signifies they have made sales but have not yet collected the cash. Inventory also ate up $352,000 in cash. Overall, they used $7.3 million in cash from their operating activities. This means their day-to-day business operations are consuming cash, which is not ideal, but not unexpected for a company in this phase. In investing activities, they spent $4.4 million. This was for license payments. This usually means they are acquiring rights to new drugs or technologies or making payments related to existing ones. Financing activities is where they brought in cash. They got about $15 million from issuing common stock. So the net change in cash was positive $3.3 million. They ended up with more cash than they started with at the beginning of the quarter. They started with $3.9 million and ended with $7.2 million. So their cash pile did grow. These notes are super important. They give us the details behind the numbers. Here they explain what they do. Citius Oncology Incorporated is a specialty pharmaceutical company focusing on oncology products. They have lympha and approved immunotherapy for cutaneous T-cell lymphoma, and revenue started in December 2025. They also mention their relationship with Citius Pharmaceuticals Incorporated, which is a larger entity and has been funding them. This section details a big corporate event, the merger in August 2024. They went from being a subsidiary of Citius Pharmaceuticals Incorporated to a standalone publicly traded company. This is a crucial piece of their history. It explains why their stock structure and ownership changed. Essentially, they became their own entity after this merger. They are preparing these financial statements according to generally accepted accounting principles in the United States of America, which is standard. They mention that preparing financial statements requires estimates and assumptions. This is important for you to know as an investor. Actual results can differ from these estimates. This is a critical section. The company acknowledges they have had net losses and relied on funding from Citius Pharmaceuticals Incorporated. At the 31st of December 2025, they had $7.2 million in cash and a negative working capital of $7.6 million. This means their short-term liabilities are more than their short-term assets. They completed a stock offering in December 2025, raising about $18 million gross and $15.1 million net. This gave them a cash boost. However, they state they expect to have enough funds to continue operations only through May 2026. This means they will need to raise more money within the next few months. This raises substantial doubt about their ability to continue as a going concern. This is a major red flag. It means the company might not survive if it cannot get more funding. They are actively looking for capital and exploring strategic alternatives. This explains how they recognize revenue. They distribute lympha through specialty distributors. They account for things like returns, chargebacks, and co-payment assistance. They are recognizing net revenue from lympha sales. They estimate things like allowances for sales returns. This table shows their gross product revenue was $4.8 million, but after adjustments and deductions, they recognized $3.9 million in net revenue. This is about an 80% gross margin on their product, which is a very healthy sign. Accounts receivable is the money customers owe them. At the 31st of December 2025, the total was $4 million. They do not have an allowance for doubtful accounts, which suggests they are confident in collecting this money quickly. Inventory levels are important. They have $22.6 million in inventory. Most of this is finished goods and work in progress. This is a substantial amount of money tied up in inventory for a company just starting to sell its product. Prepaid expenses include advance payments for things like drug substance and product costs. They also paid for annual licensing fees. This asset is related to lympha and has a carrying value of about $72.8 million. Amortization of this asset began in December 2025, when revenue started. Amortization is the process of spreading the cost of an intangible asset over its useful life. They are amortizing it over the remaining FDA product exclusivity period, which ends in August 2036. This section details their deals with Eisai and Dr. Reddy's. They acquired the license for Lympha from Dr. Reddy's after Dr. Reddy's licensed it from Eisai. They paid significant milestone payments for Lympha. A $27.5 million milestone payment to Dr. Reddy's is partially outstanding, with $18.25 million still owed. They also owed Eisai a $5.9 million milestone payment plus other costs. They restructured payments to Eisai. They made a final payment in December 2025, but still owe Eisai about $6.8 million. These are significant financial obligations. This section covers their stock. They have common stock and preferred stock authorized, but no preferred stock issued. There were several stock offerings in 2025. The July 2025 offering raised $9 million, the September 2025 offering raised another $9 million, and the big December 2025 offering raised approximately $18 million. This shows a clear strategy to raise capital through equity sales to fund their operations and development. They have stock incentive plans for employees, directors, and consultants. They granted restricted stock awards of $20.3 million worth of shares in September 2025. This is a significant incentive program. They also have a lot of outstanding warrants. Warrants give the holder the right to buy stock at a certain price. There are many different types of warrants from different offerings and agents. The total number of shares reserved for warrants is substantial. They have agreements with contract manufacturers for Lympha. They have minimum purchase commitments totaling about $16.2 million for drug substance and about $4 million for finished drug products. These are future financial obligations. This is where we see the ongoing financial ties with Citius Pharmaceuticals Incorporated. Citius Pharmaceuticals Incorporated provides them with management and scientific services. They charge Citius Oncology Incorporated for payroll and office space. Citius Pharma also advanced them $3.8 million on a promissory note. This shows that Citius Pharma is still a key financial backer. This section gives management's perspective on the company's performance. They highlight the revenue generated from the Lympha launch in December 2025. They are happy with the gross profit margin of around 80%. The company believes revenues will increase as Lympha gains market acceptance, which is a standard outlook for a new product. R&D expenses decreased in this quarter compared to the prior year. They attribute this to pre-commercial manufacturing implementation services related to product labeling serialization, which is a bit technical but implies they are moving past heavy R&D into production. This expense started this quarter because they began generating revenue. Yay expenses also decreased. They say this is due to lower setup and implementation costs for commercial services and launch activities. This is a good sign that some of their initial launch costs are behind them. This expense increased significantly due to the restricted stock awards granted in September 2025. As we saw earlier, this is a large part of their overall expenses. They reiterate their net loss for the quarter was $5.5 million compared to $6.6 million last year. The improvement is attributed to the gross profit from the new revenue, partially offset by increased operating expenses, particularly stock-based compensation. This section is all about cash and their ability to keep the lights on. They acknowledge they have always had operating losses and are relying on Citius Pharma for funding. They have $7.2 million in cash and negative working capital. This is a critical warning. They need significant additional financing to meet their obligations, like milestone payments for drug licenses and commitments to manufacturers. They are not sure if they can get this funding on good terms or at all. This is the most alarming part. Even with the recent stock sales, they only have enough cash to operate until May 2026. This means they have to find substantial new funding in the next few months. This is a classic going concern risk. They made payments related to those milestones for Lympha to Eisai and Dr. Reddy's, as discussed before, showing those significant ongoing obligations. This part is about how the company makes sure its financial reporting is accurate. They have a CEO and CFO who have evaluated these controls and found them to be effective. This is standard for this report. This is just a list of supporting documents like agreements and certifications. Now, for my take on Citius Oncology Incorporated, this company is at a very critical juncture. The good news is they have finally launched their product Lympha and are generating revenue with a healthy gross margin. That is a huge step forward from being a development stage company. The merger in 2024 and the subsequent stock offerings show a clear strategy to fund their path to market. However, the huge operating expenses and the alarmingly short cash runway are major weaknesses. They are losing a lot of money and only have enough cash to last them until roughly May 2026. This means they are in a race against time to secure more funding. Their reliance on stock-based compensation is also a point of concern given the high burn rate. The significant milestone payments owed and manufacturing commitments are also substantial risks. They really need Lympha to gain market traction very quickly and deeply to cover these obligations and keep the company afloat. For investors right now, this is a high risk, high reward situation. The potential for Lympha to become a successful cancer therapy is there, and the market has responded positively to the launch in terms of equity raises. But the operational losses and the immediate need for more capital create significant uncertainty. It is going to be very interesting to see if they can secure that much needed funding and how the market will react to their sales performance in the coming quarters. Alright, that is our breakdown of Citius Oncology Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.